Sorry when I walk, boy.
Hello, everyone. We're going to get started in 11 minutes and 50 seconds.
I saw it when I walk, boy. I saw it when I walked, boy. I saw it when I walked, boy.
Good afternoon, good morning, good evening to everyone, wherever in the world you are. Welcome to this special educational session with Gianni DePoce, lead editor of the Benzinga Breakout education and trade idea platform. Guys, we love to know where you're from. As always, there's Gianni's beautiful mug, handsome mug. We like to know where you guys are from. We'd like to know how big the Zinger Nation is. Let us know in chat. Drop your first name, drop the city, or country, however much information you are willing to give to let us know where in the world you are.
Lots of Dubai. Nicola Pigozzo from Italy. Marco from Canada. Illinois. Brussels, USA. Ireland. Chicago. Germany. Stuttgart. California. Calgary.
Look at them fly.
Yeah.
Hey guys. Hey guys, we are going to shout you out. Let us know your name and where you're from. Keep them coming. Keep them coming. As always, when we do these, we get one question over and over. Am I going to get the recording after this? As a member of the Zinger Nation, as a citizen, it is your civic duty to answer obvious questions, common sense questions when you see them arise. Help Gianni out and answer those questions. When someone asks, is the recording going to be available after this? The answer is yes. So when someone asks a question, will this recording be available? What are you going to say? Let me know in chat.
Quite the lineup of participants today.
That's correct. You're going to say yes, yes, yes. Thank you. Let folks know the recording is available to people who registered. So everyone that's in Zoom, you get the recording. Everyone who's just walking by and saw something cool pop up on YouTube and watching, you get to watch it now for free. But next time you get to register and you'll get the recording to keep for yourself. And yes, Gianni, we've got people from all over the place.
Yeah, I'm just scrolling the chat. It's pretty impressive. I think we've hit every continent aside from Antarctica.
I think benzinga.com we saw visitors from Antarctica.
Really?
On Google Analytics, yeah.
It's probably one of those scientific bases. I sure hope they have Wi-Fi down there. That'd be probably, they're probably like a satellite. Oh, someone just said they're from Antarctica. Ha ha. Hi. That's funny, Don. I saw that you were from Louisiana first.
Nice try though. Yeah, I mean, if you're in the cold in one of those like bunker structures out in the cold, doing a little trading, reading a little financial news.
Exactly.
Hey guys, we are at. Hey Pete, don't scam the chat. Knock it off, Pete. Hey guys, we are 1 minute past the official start time for this session. We do still want people to trickle in because it seems like people kind of get in around the 105, 110 mark. We'll get started in just a second, but while we're doing that, Gianni, everyone's telling us where they're from. Gianni, why don't you tell folks a little bit about yourself and where you're from?
Yeah, sure thing. So I am in the same vicinity as Benzinga, actually. I was born and raised in Metro Detroit. So I'm in Michigan right now, but my parents moved over here from Italy. So I have quite an extensive length of roots in the old European continent. And so that's why you probably heard my accents calling out some of the names. My mom was actually born in France, but my dad was born in Italy. My mom was born in France to Italian parents. But they moved here a little bit before I was born. And I ended up getting into markets. So here we are. I spent about 6 years in the financial industry, in the advisory world. I've been in the proverbial digital trading pits, if you want to call it that now, for about 10 years, going on 10 years. And so I had my fair share of losses early on in the trading career, called it, the trader's tuition or what have you. But over the years, developed a method that has begun to serve me very well. And we're going to go through some of those methods here today. It's kind of trial and error between working with the institutions while I was in the industry, and then, incorporating some of those strategies into our own that we now share through the Benzinga Breakout Opportunity Letter. So, Neil, was there anything else that you wanted to chime in on before I get started here?
No, I think you are good to go. If you're ready to present, I can close this little thing I got going here. Boom. We stop our funky beats. Let you get going.
Okay. Let me go ahead and share my screen. Neil, can you just confirm that you see my screen here?
Confirmed.
Okay, very good. So today we're going to talk about how to trade breakout stocks. Okay, so this is all about identifying stocks that are on the precipice of breaking out, the factors that we use to determine whether they're about to break out, and then how to enter and exit those positions, how to manage your risk a little bit. I'm going to share live examples that we've called out for our subscribers, made some money along the way. We're going to talk about, when we got in, why we got in, so on and so forth, break down the chart patterns, talk about some other stuff, and we'll go into even how we come up with these, breakout numbers and how we find these stocks a little bit. So we're going to start off with the tools and concepts that we use. First and foremost, we use technical analysis. Okay. So when I actually got into trading, I started learning the fundamentals, the Warren Buffett, Benjamin Graham type stuff. It didn't take me that long of observing the market to realize that stocks don't trade on fundamentals in the short term. In the short term, it's like a voting system, and then earnings, if you think about it, really are a lagging indicator because companies report their earnings from the previous quarter. So what is happening, in the 3 months in between the last earnings report and, where the stock is now. So, prices are going up and down. They're fluctuating, obviously. So, at best, I would say fundamentals are marginal. There's a lot of institutional entities that, by law, basically have to use them to, provide rationale behind their decisions. But anyways, we use technical analysis. So we study chart patterns, price patterns, momentum indicators, so on and so forth. We use it to help us spot opportunities ahead of time because the best predictor of the future is the past. History doesn't repeat, but it rhymes. And it's pretty amazing. If you go back and look at, charts that were available, in the early 20th century for, any stocks or any security for that matter, you'll see the same price patterns that we're going to talk about today. And that's because human behavior has not changed. We have different cultures and traditions around the world, but human nature itself is the same everywhere you go. Okay. But most importantly, and I've mentioned this a little bit already, is risk management. Technical analysis helps us manage risk more effectively than any other method that I found. And if you found a better way to manage risk aside from technical analysis, I'd love to hear from you on that. But, whether it's setting a stop loss, below support or, just following basic principles of, cutting your losses around 7 to 8% and, letting your winners run. Those are some of the things that we look at with respect to risk management. What if I told you that you could afford to be right just 1 out of 4 times, 25% of the time, and still be a profitable trader? I don't know about you, but those are odds I'm going to take to the bank all day, every day, especially since, the academics say you got a 50% chance of being right or wrong on a trade. Yeah, I guess from a bottom line perspective, that's true. But when you factor in things like opportunity cost and lost time, it's a little bit more complicated than that. Another principle I want to touch on before we get into the charts is the whole concept, the whole notion that sentiment follows price, not the other way around. If you've been to my webinars before, I like to give the recent example of the Corona crash that we went through last year, March of 2020. The equity markets collapsed 40+% in a month, the sharpest decline in the shortest amount of time in history. And if you go back and look at, news articles around that time, the world was ending. But guess what? That turned out to be the bottom because sentiment follows the price. Now, what do we see? I wouldn't say we're in complete, euphoria, pandemonium quite yet. It's getting there. But, we're starting to see the more accommodative, sentiments shared in the press, right? And lastly, technical analysis kind of ties into this as well. I do urban farming in the warm season of the year. So we're starting to do our first plantings right around now, actually. But it's the whole notion that there is a natural order to our world. Humans are extensions of nature, and there are no coincidences in nature. So we are still beholden to the same laws of nature, right? So the law of nature is cycles. Stocks will go up and they will eventually, inevitably come down. The question is, how long will it take? And that's because there are different cycle lengths in nature. It's not all just one cycle. There are cycles within cycles and sub-cycles within those sub-cycles. So, but that's not what we want to talk about today. Today, we want to talk about, the chart patterns and how we identify the breakouts. I will say this, you need to learn the chart patterns if you want to be a trader, okay? And the good news is that once you learn them, they can be applied to all markets, regardless of what you trade. So I trade stocks and futures, but if you're a Forex trader or you trade, crypto exclusively, Once you learn these patterns, they're applicable to all markets. So do your due diligence. Spend the time that it takes to learn the patterns. Eventually there's going to be a learning curve, right? But eventually, once you stare at the charts and stare at the screen long enough, you're going to start to see the patterns. Before you even have to draw them, you'll just be able to spot them just from your naked eye. And the two types of patterns that we want to focus on today, there's a third type that we're not going to cover because it's beyond the scope of this discussion. We're going to focus on continuation patterns and momentum patterns. The third type are the reversal patterns, but we're not trying to catch bottoms or sell tops in this presentation today. We want to talk about the types of patterns that we use to identify stocks on the precipice of breaking out. So I'm going to list those patterns off on these next couple slides, and then we're going to show some examples that come directly from our breakout series of reports. So the continuation patterns, we have the triangle family of chart patterns, is what I call them. You have the ascending triangle, the descending triangle, the symmetrical triangle. Then we have the rectangle, which kind of ties into the momentum patterns that we'll share on the next page as well. And then we have the ascending and descending price channels. The momentum patterns that we love to use, the saucer, love this pattern. We'll show you some examples of that on the following pages. Broadening wedge, another one I really like. And I found this one, I really seems to, jive well with me. I think because not very many traders use it as a momentum pattern. So it's one of those secret sauce type of ordeals whereby, the less people use it, the better it works. If too many people pile into something, its edge starts to evaporate slightly. Then we have the cup and handle pattern, another excellent momentum pattern. Have nailed a lot of winners from that one. We'll look at a couple examples that, one example that we had from before, and one example that I think you all will be very interested in seeing with respect to that particular pattern right there in the market right now. Then we have the bull flag. That's a very good one. If you see a bull flag, definitely put that at the top of your list. And like I said, the rectangle pattern carries over into the momentum side of things as well. So let's start off with the saucer pattern. Okay, so here is a chart of Fubo. This is one of the best trades that we ever sent out to our subscribers, so I like to show it. And I show it not just because it was a good trade, but it's a textbook saucer pattern, and it shows textbook entry and exit points. And I'll show you what I mean. So let's start off with the saucer pattern. The saucer pattern is characterized by an upper horizontal trend line that acts as resistance. We see how prices rallied up to and were rejected by this level 1, 2, 3 times before they finally broke out. The second portion of the pattern is characterized by a lower U-shaped parabola portion of the pattern. Okay, so the buy is triggered on a close above the upper horizontal trend line of the patterns. And as soon as we close above resistance, it's off to the races. So why close? Well, there's a saying in trading that goes, rookies trade the open and pros trade the close. If you don't believe me, open up an intraday chart of any stock and you'll see a spike of volume between 9:30 and 10 o'clock and from 3:30 to 4 o'clock. The first half hour is the rookies, trading off of emotions and the headlines from the morning. And then you see a volume and usually prices taper off or consolidate during the day. And then you see a spike at the end of the day. That's when the machines and the algorithms and, your institutional money makes their decisions based off what they want to buy or sell for the day. So we want to operate based off the closing prices, not just to enter positions, but to exit. Specifically to exit based off of stop loss. There are times where I say, hey, let's just sell the stock. If it's up, 60 or 70%, if it just rallies to this point, I'm done with it. We had a nice gain. We're moving on, looking for the next opportunity. So I'm more lenient on, exiting a position with the gain during the day. But when it comes to entering a stock and being stopped out, I save those actions for the end of the day. So we issued a buy alert on Fubo here. This has been a much more popular stock in the last couple months, but was it on anyone's radar that you know of in late summer, early fall of last year? Well, it was on our radar. We issued a buy alert on a close above 1220. That triggered in mid-October, and we ended up coming away with a 190% plus gain in not even 2 months. This was a big winner. We sold out before the peak, but look what happened. Prices peaked 2 days later, and then they collapsed. We rallied higher, formed a secondary lower high. Okay, that was a bearish signal because the trend is your friend when you trade. An uptrend is characterized by higher highs and higher lows. A downtrend is characterized by lower lows and lower highs. So what has Fubo done since we sold out of it? Well, pretty much nothing. In fact, it's still about 50% lower from where we exited. So this was a textbook example, something that I like to review periodically. Okay, here's one that we actually hold right now. This is a stock that we hold at the moment. This is Cara Therapeutics. This is a weekly chart. Okay, so here we have a saucer pattern once again. We have, once again, an upper horizontal trend line acting as resistance and a lower U-shaped parabola. That's the secondary portion of the pattern. So once again, we buy on a close above the upper horizontal trend line. Cara gapped up and surged over 30% higher this past week, but we were already in the stock. There were signs of accumulation, but look at this past week as well. I mean, volume spiked. It's one of the highest weekly volume days in history. So, actually not weekly volume days, just weeks of volume. Trading activity was very high this past week on the surging volume and prices. It closed out at an all-time high. We're up about 43%, I think, on this position right now. We raised our stop loss, to control for, additional risk and to protect some of our gains, because one of the worst things that you will encounter as a trader at some point along your journey, I'm sure, because I did earlier on in my trading career as well, is that you'll find that one of the most psychologically damaging things that will happen to you as a trader is to see a gain turn into a loss, especially when you start to get double-digit gains. So one of my rules that I employ is that whenever a stock gets above 12% of my entry point, I raise my stop up to break even. I don't want to see that gain turn into a loss, right? And then once I get up, 20, 30%, I'll incrementally raise my stop loss to protect some of those gains until I deem it appropriate to just exit that position entirely. So anyways, this was a saucer pattern, upper horizontal trend line, U-shaped parabola, secondary portion of the pattern. You buy on a close above resistance. Okay, here's another great pattern. I told you how I love the broadening wedge. This is Cooper Tire and Rubber. You probably have never heard about this company. I didn't. I found the stock on one of my screens. But this is a tire company, as evidenced by its name. It was bought out by Goodyear. You've probably heard of Goodyear Tire. They were bought out in late February. But this broadening wedge pattern is characterized by an upper horizontal trend line, once again acting as resistance. Look how prices were rejected by this, $42 mark, give or take, 1, 2, 3, 4, 5, 6 times. Okay, and then we have the downward sloping lower trend line in the pattern. So we sent out an alert in early February to subscribers. The trade actually triggered in mid-February, started to rally, and then we gapped up when Goodyear bought out this company. We then sold it once we, saw the article that said, hey, Goodyear's going to be buying this stock at such and such, so and so dollars per share. We said, okay, we're pretty much there now. Let's just get out and look for the next opportunity. We came away with about it was like a 35% gain, give or take 1% or 2 on each side, maybe in a matter of like 2-3 weeks or something. So this was a nice swing trade for sure off the broadening wedge pattern. Here's an older example. This was something we put out in early summer of 2020. This was Snapchat. This is a weekly chart of Snapchat. Once again, broadening wedge, upper horizontal trend line acting as resistance. Prices were rejected by this 3 times. 1, 2, 3. So a general rule of thumb that's going to be very helpful to you in trading is that the more times price tests a level of support or resistance, the more significant it is. When it finally breaks that level of support or resistance, it's very significant. So there's a saying in trading that goes, the bigger the base, the higher the space. The inverse of that is the bigger the top, the bigger the drop. Okay, so when you see these price patterns, in this case, this broadening wedge, it was like 6 months old. So we knew that when prices closed above the upper horizontal of this upper horizontal trend line of this price pattern, that a big move was on our hands. Okay, so we had a really nice gain, came away with like a 65% gain in like 2 months or so. yes, we did sell a little bit prematurely, but I showed you another example where we didn't sell prematurely, and we'll take a look at some other ones here. But, a point I want you to take away from this is that you don't need to buy the low or sell the high every time. You'll probably almost never do that. You don't need to, but if you do want to do that, keep trying. Never really worked out that well for me, but I do know some bottom pickers and some, people that call the tops frequently enough for them to make money, but they do have a lot more stop losses because I like to trade with the trend. But the point I'm trying to make is that there's plenty of meat in between these moves for you to make a good living. Okay. Cause look, prices bottomed on Snapchat in like March of 2020, and it already like doubled in price before we even entered the position. Okay. And then we still got out with a 60% gain, and the price didn't even peak, so we did raise up our stop loss along the way. I thought there was going to be, a little breakdown here, but I'm not going to be upset with this 65% gain, in a matter of 2 months compared to a, 100% gain in 6 months, if you will. It doesn't have to be perfect for you to make a good living is the point that I'm trying to make. All right, let's take a look at a cup and handle pattern. So this is a stock called alarm.com. Okay, this is a daily chart. And the cup and handle pattern is kind of like two saucers put together, but there's a profound, more distinct, we call it the cup portion of the pattern, and then the smaller, less distinct handle of the pattern. So once again, we have an upper horizontal trend line acting as resistance. The cup portion or the saucer, we're going to stay definitionally pure here. The cup portion of the pattern is like a U-shaped parabola, and then the handle of the pattern is a smaller U-shaped parabola. So this pattern was actually made famous by renowned trader, analyst, and founder of Investors Business Daily. I guess they sold it about a month or two ago. William J. O'Neill. He wrote some excellent work on successful stock speculation, but he brought this pattern to the public as far as I know. But same thing here. We buy in a close above the upper horizontal trend line. And we came away with like a 30%, 35% gain or something like that in a matter of like 5 to 6 weeks. We sold on this breakaway gap down lower here. We raised our stop loss that was triggered. And this turned out to be an excellent exit point because, prices continued to decline a little bit, rallied back up, made a secondary lower high, which was a very bearish signal. And now look where the stock's at. So you need to have a plan. You need to have a plan for your entry and a plan for your exit. Ask yourself, what are you doing to manage risk? What are you doing to mitigate your losses or to protect your gains should the market or the stock that you're holding decide to move against you? Okay. All right. So let's take a look at another cup and handle pattern. And I know many of you will love this stock, Bitcoin. Okay. So I don't have a position in Bitcoin right now. I do have some crypto miners. I used to mess around with Bitcoin back in college when it was like $250 a coin. But in any case, I see a cup and handle pattern here on Bitcoin. Upper horizontal trend line acting as resistance, rejected 1, 2, 3 times. And then look, we have the cup portion of the pattern that's bigger than the secondary handle, right? So on a close above this upper horizontal trend line, I'm thinking Bitcoin hits 80,000, 75 to 80,000. At least if we can close above this upper horizontal trend line. And then if we clear that 80,000 mark, I really do have 100,000 on my horizon. So that's pretty crazy if you think about it. And we're going to take another look at Ethereum later on when I tell you how to actually come up with these stated buy points that you hear me talk about. Like what number, how do we come up with the number to actually initiate a trade, right? I'll share that with you later on. All right, let's take a look at a rectangle pattern. This is a stock that we currently hold. This is NCR Corporation. To be honest with you, I have no clue what the stock does, what the company does rather, but the technical setup is fantastic. So we see the stock is in an uptrend, right? Higher highs and higher lows. And then we have the rectangle pattern. So we have the upper horizontal trend line acting as resistance. We see that prices were rejected 1, 2, 3 times. Then we have the lower horizontal trend line acting as support. We see that prices stayed above this level of support 1, 2, 3, arguably a fourth time here. So we put this out in late March. It just triggered. You could still make a case that you could get long. There's still time to get long now. But just make sure you set your stop loss within 7 to 8% of the current, wherever you get in. But yeah, we're holding this one, and I think the stock could, let's see, I think it could go to, what is that right there? 65-ish, give or take $5. So I like the stock, but I wanted to show it to you because this is one we currently hold. So put it on your watch list. Decide for yourself. This is something you still want to buy. We already got into it. So, talked about how we trade at the end of the day. We do that to help manage for risk, right? So if you chase a stock, one of the rules that I follow is, if a stock is 5 to 6% above my stated buy point, I don't chase it, right? Because it's all about managing risk. If you chase a stock, you're going to be more exposed to the downside based off where you set your stop loss, right? So we want to make sure that, we're not acting too hastily and just buying a stock because we have FOMO, fear of missing out. It's important emotion to learn to manage, especially in trading. I'm not one of those people that says, destroy your ego to become a good trader. You have to learn to control your ego. You have to drill it into submission. You must be in charge of your ego, not some headline that you're reading, on Twitter or wherever it might be. You are solely responsible and in charge of your own actions and behavior in the market, okay, especially as a trader. So you have to drill it in submission. You do that by having a method, a process, a system that you stick to no matter what. The ability to stick to a strategy matters more than the strategy itself. Okay, so let's talk about a descending channel. This is Riot Blockchain. I talked about crypto miners. So I want to point out the descending price channel because this is what caused us to enter the trade earlier this year. So we bought on the close above the gap right here, but that was because we identified the descending price channel. So you have two downward sloping trend lines in which prices are consolidating or compressing their volatility. So volatility tends to compress before it expands and vice versa. So we got long here, ended up coming away with a 110% gain in not even a month. It was a fantastic trade, fantastic swing trade in a short amount of time. This is a daily chart, by the way. And now, well, let me say this. Look at where we sold, pretty much where the stock is now. You've heard me talk about opportunity cost. Holding onto a stock that is not performing for you is effectively dead money. You're losing out on the opportunity to be deploying your capital elsewhere where it could actually be working for you. So right now I identify a symmetrical triangle, which is something we're going to look at on the next slide, which makes this an excellent segue. So the symmetrical triangle, downward sloping upper trend line, upward sloping lower trend line. And, you don't always buy, at least I don't always buy on a break above the upper trend line. I like to wait and see for a clearance of resistance. So on this Riot stock, it's a little hard to see. I'm going to say around, if it closes above whatever this closing price is here, I think it's around 62, 63 bucks. That would be a good entry point. And I think Riot could hit, I think it could go over 100 bucks, honestly. So, but don't rush into it. You have to be patient, control your actions. You're in charge and responsible for your actions, all right? Okay, so let's talk about the bull flag, okay? Because this is one of the most powerful momentum patterns in all of technical analysis, known as a fast technical pattern, which means they tend to resolve fairly quickly. So this is High Max Technologies. This is a stock that the trade just triggered this past week, actually. A couple patterns here. So a little review. We'll talk about the bull flag, and then we'll talk about the symmetrical triangle. So we have in this case, rounding bottom or saucer. It looks about the same, but the rounding bottom is a reversal pattern. So, you would buy, we didn't buy, but because it wasn't on our radar yet, on a close above the upper horizontal trend line. As prices broke out, emerged from this rounding bottom, we established what's known as a flag pole, okay? Following the flag pole, a flag pole is basically when prices surge great amounts in a short period of time. Now, look, prices went from 8 to over, they basically went up to 18 in 3 weeks, right? So you're rallying over 100% in 3 weeks. That's something that you would consider a flag pole. Then you see prices consolidate. So call this symmetrical triangle. The bull flag the flag portion of the bull flag can unfold in two ways. You have what's called the flag, which looks like a rectangle, and then you have the pennant, which looks like a symmetrical triangle. Okay, so you can name these a couple different things, but what the pattern looks like matters more than the nomenclature. Okay, so this trade just triggered because we closed above an important level of resistance. We're up about 4% on it. I have a target on this stock of around 30 bucks. We'll see where it takes us. We are still managing risk nonetheless. My price target from a practical standpoint means absolutely nothing to me. What matters to me is managing my risk. And if I'm right, I'm going to keep raising my stop loss to protect my capital. If a stock reaches my price objective and I'm starting to see signs of technical deterioration, I'll get out altogether. But I'm not forcing my hand. You have to play the hand that the market deals you and not be afraid to pay the house. If you want to be a professional trader, you have to approach trading like a business. Every business has expenses. You will encounter losses as a trader. There is no trader out there, guarantee you. And if they're telling you otherwise, they're lying to you. Every trader takes losses. Okay, it's all about how you manage those losses. Then what makes you a good trader, right? So you can't take them personal. It's part of the business. If you're at the casino, you're going to pay the house. I don't consider the stock market to be a casino. The odds are way better in the stock market, in my opinion. But you still have to know how to accept and react properly and accordingly when the market is telling you you are wrong. Okay, let's look at an ascending triangle. This is another crypto miner, Marathon Digital Holdings. So we had a buy trigger on this about a week ago. We're up about 12%, give or take a couple of percent on this one as it is. Ascending triangle, these are known to be continuation patterns. So when you see an ascending triangle, you have to ask yourself, what is the trend? You've heard me say the trend is your friend. Well, in this case, it's very clearly up, higher highs and higher lows. Look at my laser pointer. Each subsequent high is above the previous low, and each subsequent low is above the previous low. I should say, I think I said it incorrectly. Each subsequent high is above the previous high, and each subsequent low is above the previous low, right? So here again, we have an upper horizontal trend line acting as resistance, right? We closed above it a couple weeks ago. And then we have the upward sloping lower trend line that's representative of a compression and volatility. Remember how I said volatility tends to compress before it expands? Volatility does not just exist on the downside. It exists with the upside as well. You have upside volatility and downside volatility, okay? So I think Mara's probably, I think it'll at least hit 70, probably eventually 100, especially if, Bitcoin hits $100,000 a coin. So this is the ascending triangle, right? All right, so let's take a step back and look at the S&P 500. Okay, so this chart comes directly from our elite service, which is something that we send out 3 times per week, provide you up to 3 trades per week. But then we have the monthly one, we send you a monthly pick, a weekly one where we send you a weekly pick. But this is something that I highlight in the elite service, and I share it with you today because this is my technical analysis of the S&P 500. And there's so many patterns here. It's a nice blend, so I think it's an excellent example. We go back here to July 2020, a very short descending price channel. We go into August 2020, a couple weeks ascending price channel. Then we have a multi-week saucer pattern, right? Remember when I said the bigger the base, the higher the space. Look at the size and length of the move following the emergence from the saucer pattern compared to the other smaller patterns identified on this chart. It was much more profound, right? So then we had an ascending price channel that formed after prices broke out from the saucer pattern. And then we had a descending price channel. I can't really say that we have at least I don't see one, a price pattern right now, but I do observe a couple bullish breakaway gaps, which is very bullish. When prices gap up and close out near the highs of the day, it doesn't get more bullish than that, folks. So that is price action you must respect. And another thing here is look at the volume. So when you see volume trend above the 20-day exponential moving average on, it's significant, right? So if it's happening on rising prices, it's significant. Notice how that's not happening right now, but I'm not too worried about it yet because that is not what pays you. Volume doesn't pay you, price pays you, right? But another thing that I'm really happy to see is that after 6 months of bearish divergence in price in the RSI indicator, bearish divergence is when prices make higher highs, but the momentum indicator does not confirm the high. We had quite a long bout of bearish divergence for 6 months, but we just finally achieved an overbought reading on the RSI indicator after Friday's close. That makes me very happy. And in my through my method of analysis serves to confirm the bullish momentum in this market, which must be respected. Okay, so I'm sure you're asking, Gianni, how do you find these stocks? Well, I look at hundreds of charts a week. I could even be close to 1,000 on some weeks, just depending on what I'm doing or how the market's behaving. But there's two approaches. You can take a bottom-up approach where you look individually at stocks and try to find the themes that you're seeing, strengthen. Are we seeing a lot of strength in energy or biotech or semiconductors, so on and so forth? I know some successful bottom-up traders, but you do a lot of work, and I think the reward that you get, you have to do a lot of work before you can finally start to pick up on a theme, right? So I consider myself a top-down analyst. I look at the broader macro trends of the market. How does what's happening in the commodity space affect, interest rates? How does the dollar's performance affect, the commodity space or the bond market? And how does that manifest onto the stock market? Stuff like that. So I look at broader trends and then I narrow it down to the sectors. And then I try to find the strongest stocks within those strongest sectors, right? So there are four main asset classes to watch. You have your currencies. Your Forex market's the biggest market in the world. That's where the central banks play. Call it the Wild West, aside from crypto, the Wild West of the financial markets. Trillions of dollars are exchanged daily in the Forex market. Then you have the interest rate or the bond market. That's the next biggest market. The U.S. market, the Treasury market, is the biggest and most liquid market in the world. I don't think that there will be hyperinflation so long as that's the case. As long as the U.S. dollar has access to the deepest and most liquid capital markets in the world. I have scoured the annals of history, and I've never seen a case where a reserve currency of the world ended up in hyperinflation, barring some sort of cataclysmic event, right? So there was a case, quick history lesson, digression. A Roman emperor was captured by the Parthians, which is the empire that ruled over modern day Iran at the time. And, they captured him, and, pretty much financial capital left Rome. Like, wow, the emperor's captured. Why are we investing in this space? So I don't think that's going to happen in the United States now, but you never know. I mean, if 2020 taught us anything, it was to be ready for anything at all times, right? But I digress. Then I look at stocks, what's happening in the stock market. Everything that happens in one market is going to affect what's happening in another. Think of it like a ripple effect. Nothing happens in a vacuum, okay? We call it the principle of interconnectivity. What's happening in bonds is going to affect what's happening in stocks. It's going to affect what's happening in commodities, which is the next sector. Commodities have really started to rally well in the last year or so. They bottomed out. Many of them bottomed out, around the hyperdeflationary episode, especially what we saw in crude oil when prices went negative in April of last year. Now, I'm kind of thinking this over in my head. Should we start to consider crypto as a main asset class? Well, the market cap is over $1 trillion, so it's significant, no doubt. It becomes more pertinent by the day. Neil's been doing these webinars with me, and this is a slide that I frequently carry over because it's so important. And my description by crypto keeps growing each time we do it because it's becoming more and more significant to me and to the global economy, especially, when you see central banks like the European Central Bank. I mean, they're out like weekly saying, oh, we want a digital euro. So the blockchain will be incorporated into the monetary system as we know it. The question is what happens to crypto once the euro or the dollar eventually is a blockchain based currency? I think that's the $1 trillion question, if you will. But for the purposes of this presentation, we're going to assume that we're all trading the U.S. markets. It's the most liquid, biggest stock market in the world. And I know we have people from all over the world. The U.S. market's the best one to trade. So we're going to assume that were all trading the US market. And the reason I bring this up is because, when you do intermarket analysis, if a local currency is depreciating, but the stock market is appreciating, you're losing money to global Forex flows. So that's beyond the scope of this discussion, but I just want to drop that little, tidbit in there. So, if you want to look at the markets, the financial markets, like a hedge fund manager, you have to look at how a country's stock market is performing relative to its currency as well, right? Okay, because if a stock market is just rallying while the local currency is depreciating, that's a function of currency devaluation. If you see a stock market rallying in conjunction with its currency, that's indicative of demand, not just domestic demand, but foreign demand. Foreign money is pouring into that country because they want those assets denominated in that currency. Okay, so what are the strongest performing sectors that we have seen in the market? Well, in the last few years, it's been tech, communication, biotech, consumer discretion, value. Inflation-sensitive names have put on a nice run really since August of last year. Now, growth has started to pick back up in the last week or two. Everyone was screaming how, the growth outperforming value is dead, tech is dead. I mean, people, this is a decade-long trend, and you've heard me say the trend is your friend. So that must be respected. Now, to piggyback off that statement a little bit, I think the most vulnerable long-term trend that we're seeing right now in the market is the 40-year plus bull market in bonds. I think that is susceptible to breaking down. We starting to see some signs of it, but the Fed's still doing QE. They're keeping rates low for the foreseeable future. But we're still in a short-term downtrend in the bond market. But in any case, we want to figure out what are the strongest sectors within the stock market and then dive into those sectors. So if we see tech outperforming, what are the strongest or best acting stocks within the tech sector? This comes to the concept of relative strength. One of the best ways to outperform the market in the long run is to belong the strongest stocks within the strongest sectors. If you're buying stocks in downtrend, in a downtrodden sector, you're going to have a bad time. And I'm speaking from experience very early on in my career. It took me a few years to figure that out, but thankfully I did, or else we wouldn't be here talking about this today. The trend is your friend. Okay, so here's another important chart or slide that I want you to take away today. This is going to lead us into the next thing I want to look at, which is ratio analysis. These are the 11 spider ETFs: XLC, XLY, XLP, XLE, XLF, XLV, XLI, XLB, XLRE, XLK, XLU. We want to compare the sectors of communication, consumer discretionary, staples, energy, that's conventional energy, financials, healthcare, industrials, materials, real estate, tech, and utilities relative to the overall market. This is how we see what is outperforming the best. And we do that with ratio analysis. Okay, so welcome to the world of ratio analysis. We use this to tell us whether a sector or even a stock for that matter, and I'll show you an example in the next couple slides, how it's acting relative to the overall market, right? So this is a ratio between semiconductors, SMH, and the S&P. So what does this ratio tell us? What do we see? We see an uptrend, higher highs and higher lows, going back years. It continues even before 2016. We see an ascending price channel, okay? This rising ratio tells us that you can obtain better returns, a better bang for your buck, investing in semiconductors than in the broad S&P 500. Now, this rising ratio doesn't just mean that the semiconductor sector is rallying more than the S&P, but it also means that when both of them fall, if they fall together, it would mean that semiconductors are falling less than the S&P. So that's what it means when this ratio is rising. It can mean that prices are rising faster in the semiconductor sector relative to the S&P, but it can also mean that prices are declining less relative to the S&P when they're both falling. If the ratio is falling, which we see in a couple of cases, but notice how it doesn't last very long. It means that the S&P is rallying more than the semiconductor sector or falling less than the semiconductor sector itself. Okay, so that's how you use ratio analysis. The good news is I talked about the importance of learning the chart patterns early on in this presentation. And it's true because you can use this on ratio analysis. So I share this chart here. This is the ratio between value and growth, or growth and value. Growth is the numerator, value is the denominator. What do we see here? A very clean uptrend going back years. Okay, growth is where the money was. You wanted to be long tech, your Amazons, your Teslas, your Googles, your Apples, your Facebooks, not your marathons, not your US Steels, not your Bank of Americas. That this is what this ratio tells us. And if you respect the trend, you need to avoid those lagging sectors. But what do we see here? It looks like an inverted saucer rounding top. Remember how I said that basically since August, well, we had a secondary slightly higher high here, but basically since August, you're better off being in inflation sensitive or value oriented sectors compared to the growth sectors, right? Looks like we have a rounding top. We broke below support. And now what are we seeing? We're seeing what might be a retest of that support level. So another very key principle I want you to take away from today is that when support breaks, it becomes resistance. When resistance breaks, it becomes support. So we're coming up to a major crossroads here with respect to the growth versus value trade, right? We broke below support. We see that here. Now we're coming back up to test former support, now resistance. If this level holds, we're on the cusp of a new regime in this market. But you know what? We did make a higher low. Look at this low compared to the low from early 2020. This is, the subjectivity of technical analysis, which makes risk management so paramount. You don't need to be right all the time. I think I explained it already. You just need to be right enough and have your winners be much bigger than your losers. So this is a big test we're coming up on. Will former support, now resistance, hold in this growth and value ratio? Or is growth set to take off again? Remains to be seen. So it also helps you spot emerging trends. So you heard me say that, energy was a downtrodden sector. Take a look at this low that the energy sector made. This is XLE over SPY. And we made a lower low in price, but a higher low in the RSI indicator. This is a case of bullish divergence. Now, what is the price pattern we see here? This is a broadening bottom, but we haven't broken out of it yet. The ratio would need to close above the upper horizontal trend line of this pattern acting as resistance, okay? Until it does so, this is in a downtrend. Crude oil's rallied, near $100 if you consider the trading down into negative territory. Last year, we went from negative 37. I think we rallied as high as like 72. So that was over $100 move in not even a year. That's huge. But the energy stocks themselves have not done that well because a lot of these companies still weren't profitable at these low oil prices. But if this ratio can close above this upper horizontal trend line of this broadening bottom, I think energy is going to pick up. And, then you'll see your marathons and your Exxons start to outperform again. But until that happens, you have to respect the trend. But I think it's possible it happens, when we look at inflation expectations at decade plus highs, higher than they were before the financial crisis. It's huge. So if the inflation continues to pick up, which the data seems to indicate it will, we should see this ratio start to increase. We also do this for stocks, right? You heard me say strongest stocks in the strongest sectors. I shared that high max technology stock earlier, and I did the same thing for the sector on this stock. The stock's been outperforming the S&P for years, starting to emerge from a multi-year rounding bottom pattern. Already broke above resistance. We had a successful retest. If we can exceed this high from earlier this year in this ratio, I think this stock's going to be off to the races. Okay, so we want to look for signs of accumulation in the stock. We talked about that briefly. More buyers leads to rising prices. More sellers leads to falling prices. Everyone's an expert on short squeezes now, thanks to the GameStop and AMC fiasco earlier this year. But essentially, when the shorts cover, they're buying back the stock. So you can see how the influx of buyers leads to a surge in prices higher. We use the 20-period exponential moving average. So if we're looking at a weekly chart, we want to see how volume is acting in the more recent weeks compared to the previous 20 weeks, right? Same thing holds true for the day, but just with a different periodicity. Okay, so we had about 12 minutes left. I want to make sure we get through the Ethereum chart that I promised you. And then I know Neil has some important info to share with you as well. So let's talk about timing the breakout. You heard me say, time is not money. Time is precious. Time is more important than money. We're all going to expire. But in the fiat monetary system in which we live, the money is infinite. Infinite rather. I mean, after all, it seems like every other week we're printing, another $1 trillion here and there, $1 trillion for you, $1 trillion for me, $1 trillion for everyone. But time is not like that, unfortunately. And the reason timing the breakout is so important is because an improperly timed purchase of a breakout can damage one's risk reward ratio. And that's the most important thing as a trader. This is why we like to trade at the end of the day. The closing prices matter the most. We want to trade with the big dogs, with the institutions, with the entities that actually have the buying power to move the price of a stock. I don't have hundreds of millions of dollars at my disposal to actually move the price of Apple, but your Fidelity Growth Fund does, okay? Because the fact of the matter is unless you're moving hundreds of millions or billions of dollars worth of money, you're not moving the price of a stock. Now, the exception is penny stocks, but we don't trade penny stocks, so that doesn't matter for now. So by definition, an upside breakout occurs when a market or a stock closes at a new high above a level of resistance or above the previous highest closing high. I'll show you what that means in the Ethereum chart. The same thing holds true for a downside breakout. You either break below support, close below support, or below the previous lowest closing low. Different breakout price points exist for different breakout time points. So you heard me say that the length of a support or resistance level is significant, right? So if it's a longer level of support, it breaks, it's more significant than a shorter level of support breaking. So a breakout in a weekly level is more significant than a breakout on a 2-hour chart, if you will. Okay, so let's take a look at Ethereum and how we use this understanding to initiate long positions in this cryptocurrency. Now, we've been doing these webinars for a few months now, and we've been tracking this chart. So this is the same chart that we're continually updating, through the new webinars. So the first pattern we identified last summer, ascending triangle, highest price within this consolidation, the highest closing price within this consolidation, within the ascending triangle was 248.44. So to keep it simple, we said, hey, let's get long on a close above 250. That happened. We broke out. The next pattern that formed was a saucer pattern, upper horizontal trend line acting as resistance, U-shaped parabola acting as the lower portion of the pattern. The highest closing price within this pattern was at 475.99. So let's keep it simple. We can say let's get long on a close above 476. That happened on November 12th. Ethereum then ripped higher. Okay. We said to reduce your exposure here. It turned out to be a good idea for about a month or so, but we didn't break down as much as we did, as much as we thought. So we said, hey, we see another ascending triangle. This isn't an uptrend. This is a continuation pattern. It's time to get long again. So we saw that the highest closing price within this ascending triangle was at 1392. A close above that mark, we said, hey, let's just keep it simple. Let's get long on a close above 1395. That happened on February 2nd. We rallied again. Now, in the last 2 months or so, we have another saucer pattern developing. Okay, it's a similar pattern to last year. Look how we had a ascending triangle and then a saucer followed that. I just noticed this now as I was talking about this live. So that's kind of cool. I don't know if there's any significance to that, but in any case, we see that the highest closing price within this saucer pattern is, or was rather, because we already broke out, was at 1957.47. So to keep things simple, let's just say, hey, let's get long on a close above 1958. And that happened on April 1st. So my target on Ethereum that I've been sharing for the last few months is around 2,500. We're not far from that now. We'll probably go higher, but I want to see what the technical picture looks like if and when we actually get there. So that's how we come up with our stated buy points. So Neil, you probably want to chime in now. So since you're good and efficient at sharing this type of information with the viewers about the breakout opportunity letter, we send it out, monthly, and within the first 7 days of the month, and we give you the name of the stock, the ticker, tell you a little bit about it. We break down our 3 delta factors, 3 delta trade factors, which are the main criteria that we use to determine whether a stock is a good breakout candidate or not. So I'll tell you what they are. It's price patterns, it's volume, and it's relative strength. If those factors are satisfied, they get put into our newsletter. If they don't, we're on to the next one. So Neil, my understanding is that we have a special deal for viewers of this webinar here today to sign up for the breakout opportunity letter.
That is right, Gianni. So we got a bunch of questions in chat. I was trying to type a nice little outline of how the subscription works. I'm going to drop this in our non-registered chat over here on YouTube. Hopefully you guys can see that. It's a little condensed, but at any rate, the starter package here is a swing trade per month with lessons and with research on the stock. Every trade idea comes with an entry price, a target sell price, and a stop loss, which is we're almost always shooting for about a 1-to-4 risk reward ratio. That's always coming with additional research and additional lessons. Explaining what goes into this. A lot of this is based on some good old classic technical analysis. So as you're reading some of the books that Gianni is basing a lot of this stuff on, which is, really the canon or like the mainstays throughout, like what fund managers use, what Gianni mentioned William O'Neill, what Investors Business Daily is all based on. That is the stuff that you're going to learn and get reinforced on an ongoing basis. So you can absorb that strategy and get hard, fast, sort of very easy lessons on an ongoing basis. It is a stacking subscription. The first one, this whole thing, you can get everything right now. And it's a free trial with a 14-day money back guarantee. Look at it that way. So you are purchasing. So it's not necessarily free. I take that back. It is a trial. You may trial it for 14 days. I'm used to Benzinga Pro. You may trial it for 14 days. And there's a complete, no questions asked. Doesn't matter. You don't like it. You don't like the stocks. You don't like the format. You don't like how the website works, whatever. You don't like text message notifications with these entries. You can cancel, no questions asked. Rodrigo, our wonderful customer success manager, will take care of you and maybe help you get something else that is better suits you. No problem. So I'm going to drop the link into both chats right now. Give me a second, guys. It is right now 30% off. So that gets it down. That gets it down to less than a Disney Plus subscription. So that's less than $6 a month for the tier 1 there. However, I really, really recommend at least getting tier 2. So you want to go 1 and then 2. So you're going to get 1 a month, 1 swing trade a month. And then once you get that tier 2, you're going to get an additional 4 a month that are delivered each week, 1 a week, with all of those explanations. That way you can actually check them out, try the stocks out, see if they actually match the way you want to trade, and honestly, see if you're profitable. And if you're profitable using the information that's given to you from the subscription, then you know. So that's the best way to find out. There is a little bit of a philosophical discussion in chat that I'm going to address head on. Just be open and honest. Some folks say, I don't want trade ideas to be given to me by someone else because I feel like that's being spoon-fed. That's totally understandable. Then this might not be for you. If you don't want to get trade ideas and research done for you by someone that trades and lives in the charts, that's totally fine. Use another tool and do the research yourself. Absolutely. What we do with this product, though, is we are giving you those trade ideas with that Gianni is doing all the research and work on, along with the education, because I do not want you to be subscribed to this product for a long time. I want you to get what you need out of this. I want you to make money, and I want you to learn the systems and learn how Gianni thinks about the markets and go trade on your own. That's all there is to it. Then you can go get a tool. You can talk to Gianni about what charting tools he uses whatever he uses to screen for stocks, and you can go out there and do stuff on your own. But I can tell you for sure that trading is a lot better when you're doing it together, and that's what we're trying to do here. And yes, some of you know me, and for those of you that don't, I have no problem saying that I use Gianni's trade ideas all the time. I have no problem. I work at Benzinga, so I get this for free. Every single time a new alert comes out, I add it to my watch list. I read Gianni's analysis. It makes me smarter, and I use it to make my own money. I have no problem saying that I steal these ideas and get them for free. So I really, really recommend get in there. I know, Gianni, you probably want to share some of the books that you've read, and I know everyone here wants to hear it. So I just want to show folks a preview. I'm going to open up my screen just so you can get an idea of what the logged in experience looks like.
You need me to stop sharing my screen now?
No, I think it'll let me take over.
Okay, cool.
Okay, you guys should see the Smith & Wesson's SWBI a recommendation. Do you see that, Gianni?
Yeah, I do.
Okay, thank you. So this is the basic format. Right here, very, very simple. Ticker, buy signal, target sell price, stop loss. Done. That, for a lot of people, that's all you need. If you just want trade ideas, that's all you need. But if you want to understand how these trade ideas come up, you get the full analysis, you get fundamentals, you get technicals, you get an actual strategy based on Gianni's Delta trade system, which I don't know how much background you actually gave Gianni, but that comes from his years of experience of basically ripping off the ideas of really smart people from Wall Street. This is consistent stuff for fund managers. So it's not just made up flu. So you're getting all of that with these trade recommendations along with ongoing education. And then you can see some past picks here. So this is what the logged in experience looks like. You also get an email alert that with new trade ideas and with it, if something happens, if one of our stocks spikes up and hits its target, you're going to get an update. You're also going to get to, if you opt into it, text message alerts. So if you're like me, I like to see the SMS, and I just read it and I'm like, all right, here we go. And I look at it on a chart, try to understand what Gianni's looking or what he was thinking. And then I come back to the site and see if I was on par with the way that Gianni was thinking about it. So this is just one of many, guys. It is a 3-tiered subscription. So make sure you get at least 1 and 2. So that way you're getting 5 swing trades a month. So you can know if you like it. 30% off the whole thing. Everything's 30% off. And that's an ongoing coupon. So like the lifetime of subscription will be 30% off. So if you go ahead and grab that, you will have 14 days to make your decision. And something tells me that after the first couple of days, you're going to like it and you're going to want to stick around. There's a reason why Gianni has thousands of subscribers. And guys, to get to the next tier, you've got to get the first one. The first one is sort of beginner, and then to get to the next one, you've got to make that purchase, and then you will see tier 2. All right.
Would you like me to share some of those books real quick?
Yeah, Gianni, go ahead and share the books, and I'll just drop some information in chat.
Okay, so there's about 4 or 5 books that have impacted me significantly in my journey of learning and then using technical analysis. The first one is Technical Analysis of Stock. Let me see, where's that book at? It's Edwards and McGee, Technical Analysis of Stock Markets, Edwards and McGee. The second one is Technical Analysis of Financial Markets by John Murphy. Another one is Intermarket Analysis by John Murphy. A fourth one is How to Make Money in Stocks by William J. O'Neill. And then the last one is the ultimate book on stock market timing by Raymond Merriman. Those books have completely revolutionized the way I trade. And so I would highly recommend you take a look at all those as well.
All right, there you go, Gianni. I don't want to take any more of your time. We are 2 minutes past the hour. I know that you've got a family and a weekend to get back to. So thanks so much for spending time on a Sunday with us. Also, you were fantastic on the boot camp yesterday.
Thanks, Neil.
Yeah, so just a lot of output from you this weekend. So we
Good.
appreciate it, man.
Pleasure to be here. Thanks for having me as always. Enjoy the rest of your weekend as well.
Thanks, man. See ya.
Ciao, everyone.
All right, guys. I'll stick. This is the part of the show where I stick around and you get to you own me for up to 5 minutes. I might leave earlier if you are mean to me. But you own me now, and I will drop in any information that you have. I will answer any questions that you have. Note that Rodrigo was kind enough to share his email and his phone number with you guys. That's his direct line. He is the customer success manager for these subscriptions. All he cares about is making you succeed, because if you succeed, we succeed. So if you don't like something about the product, you tell Rodrigo. Rodrigo tells the rest of the team, we change the product. We make it better for you. And that's how this thing works. It's only gotten better and better and better over time. Folks that have been on this for the past year would tell you, you wouldn't even recognize it, how much better it's gotten. This is not Benzinga Pro. Benzinga Pro is software for you to do your own research. So once you get out of the beginner stage and you become your own Gianni DePoce, then you use Benzinga Pro. If you're not quite ready to be completely self-directed and you've still got something to learn, or if you just don't have the time to do your stock market research, maybe you have a full-time job, maybe you're enjoying a life of leisure, this is for you to get the research done for you. Yeah, and thank you for dropping the books in there. Edwards and McGee, John Murphy, William O'Neill. Is it William J. O'Neill is going to be another one in there for sure. Gianni and I are both big William J. O'Neill fans, and I would say Gianni turned me on to it. He's probably about 5 books ahead of me on his 5 really large books ahead of me on his technical analysis journey. The additional $47 charge, I'm going to share my screen. Screen share time. Show and tell. Okay, you guys should see the checkout right now. This, where is it? Wait, do I see it? Oh, yeah, this blue thing, this one-time offer is completely different. This is just a special little offer for you to get our daily newsletter from our news desk. This is every morning in the pre-market. This is our team of reporters and analysts saying XYZ is happening in the pre-market or happened yesterday after hours. And so these are the stocks that are going to do stuff today. It's a one-time payment of $47 and is completely separate from Breakout with Gianni. This is just a bonus. Normally, this is $97 a year, but we just give it away for a one-time payment. So you're getting the full picture. So you're basically getting a news subscription, stocks to watch every single day for a one-time payment of $47, in addition to your trade ideas and your education delivered via email and text SMS. So totally separate, but I love it. I would say almost. So when I follow a lot of traders on Twitter, and I can see the purchases coming in here on the bottom left, but I follow a bunch of traders on Twitter, and at least one of the stocks talked about, and there's usually like 3 to 5 talked about in this newsletter, at least one of them is always the stock that everyone is buzzing about on Twitter afterwards. So it's just a great way to start your day, and I think like a super amazing value. But I mean, come on, get real, guys. Look, this is, what is this? 63.05 over 12 months. I don't even, what is that? 12 or 63.05 divided by 12. That's $5.26. That's $5.26 per month paid annually. That's less than Disney Plus. So again, this is where I do the goofy thing. I'm saying, you sit around, watch The Mandalorian all day, or are you gonna learn how to become a profitable swing trader with awesome trade ideas given right to you, so you can earn while you learn. Does everyone have the link? Yeah, guys, and we're getting that question. The recording is available to folks that are watching on Zoom because they registered for this. If you registered, you get the content.